Markets are on the move and optimism is back. After a rocky start to 2025, investors around the globe are breathing just a little easier. But should they be? Welcome to Clear Perspectives, the third quarter 2025 Marietta market. I'm Mary Allmon, partner and portfolio manager. Let's rewind. Earlier this year, inflation spiked, tariffs returned to the headlines, and there was real fear of the 1970s-style stagflation repeat. But as the second quarter progressed, worst-case scenarios were avoided. Now, policymakers across the globe are stepping in with pro-growth initiatives, and markets have rallied in response. Here in the US, growth has slowed but not stalled. We think there are four major paths the US economy could take from here. Let's break them down. 1. Soft landing. I put this at about 50% likely. In this path, inflation nudges slightly higher, but the Fed still has room to cut rates. The economy avoids recession, and we see 1 to 2% GDP growth, and maybe a pickup to 3% by the end of 2026. We think markets will respond positively to this scenario. 2. Stagflation delayed, about 20% likely. Tariffs and spending push inflation above 5%, and growth also stalls. The Fed stays restrictive. Here, recession risk rises, and markets likely stall as well. 3. High inflation, high growth, about 15% likely. Stimulus boosts activity and inflation. The impact on markets? Well, mixed. It depends on how hot inflation runs. 4. Let the good times roll, also about 15% likely. In this path, inflation drops to target, rate cuts can resume, and growth picks up. Consumers and companies spend freely. This is really the dream path for a bull market. Our base case? A soft landing, and we think that's a net positive. US stocks have soared in the second quarter. Mega cap tech, AI optimism, and investor enthusiasm pushed benchmarks to record highs. But let's be clear, this rally is very narrow. Small cap stocks are lagging. Valuations are stretched. The S&P 500 is trading at nearly 22 times forward earnings. Earnings growth is still supportive, with about 9% expected this year, accelerating to 14% in 2026. But if the fundamentals falter, so will markets. International markets are also very strong. The IMF forecasts 2.8% global GDP growth this year, driven largely by emerging markets. We have a very positive view on international equities, favoring regions with clear policy support from stimulus measures. China, for example, is leaning on consumer-driven stimulus. Europe is cutting interest rates and investing in defense spending. A weaker dollar is also giving foreign stocks a boost. Further, international valuations offer relative value as they're still trading at or below their historic PE averages. There are considerable macro risks which we take into account, including tariff flare-ups, an escalation in the wars in Ukraine and the Middle East, and/or a dollar rebound. Bond yields have been range-bound throughout this year's recession scare, geopolitical conflicts, and shifting Fed expectations. Yields are steady, and high-quality fixed income offers attractive income, especially in a risk-averse portfolio. We favor a conservative approach focused on short to intermediate-term maturities. The takeaway? While uncertainty lingers, economic resilience is real, and markets reflect that. We'd welcome an opportunity to hear your thoughts and comments for the second half of 2025.